I welcome you once again to my channel. Remember, it's still Fayol Accounting Academy for undergraduates. And I am still your anchor, Fayol the Great. I am here to take you through the journey of accounting and make it a pleasant experience for you. And remember, if you have not subscribed to this channel, hit the subscribe button. It's a very simple thing to do. Hit the subscribe button, be a member, not a number. And then as you do that, turn on the notification button so that you will get notification whenever a new video is posted. Give a like to our videos. After watching, give it a like. Tell us you love what we are doing. Use the comment section if you have any question or suggestion or there's something you're not happy about. We will definitely get back to you. Moreover, invite your friends, your accounting friends, your business students friends who are in year one, who are taking final SEC 101. Invite them to come on board in this channel. We will make it a pleasant experience for every one of you. All right, that being said, we have introduced the channel, and this is our first lesson. And in this lesson, we are going to be laying a theoretical framework for the study of financial accounting. It's a very interesting subject, like I always mention. We want to lay a solid background that will help you succeed in this course. As a result, today we will be taking on what is called terminologies. Terminologies is nothing, don't worry about the big word. It is basically definition of terms associated with the study of financial accounting. There are very many of them, but we are going to take as many as we can in this video. The essence is to help you fall in line as your study proceeds. If you see these terms or if you hear them being mentioned and you don't know what they are, it will be difficult to know why they are being applied in that particular situation. Let's go on with the study. First on our list is bookkeeping. What is bookkeeping? Bookkeeping is the systematic recording of business transactions in such a manner that at the end of any particular period, the true nature of the business could be clearly seen from the records kept. It's as simple as that. Recording business transactions in a systematic manner, following certain rules and procedures to make it easy for the activities of the business to be clearly seen from the records that have been kept. Most people often confuse bookkeeping and accounts. They are two different things. Bookkeeping only ends up with the recording of what? Business transaction. It doesn't go beyond that. Accounting takes it off from there. Just know that bookkeeping is the systematic recording of business transactions in such a manner that at the end of any period, the true nature of the business can be clearly seen from the records kept. All right, let's talk double entry. What is double entry? As the name implies, double entry refers to the recording of business transaction in two places, dual recording. Now, the rule of double entry states that every business transaction must be recorded twice in the book, one on the debit side, one on the credit side. Now, this means every transaction in a business affects two items. And for the record to be complete, the two items must be clearly recorded. Take, for instance, a businessman on a particular day bought fuel and paid cash. If you look at this statement, two things happen. One is he bought fuel, and two, he paid cash. Now, what is fuel purchase? It is an expenses because he paid money to receive a benefit for the business, which is what? Fuel. And then the other one is what? He paid cash, which means the cash he paid left the business and fuel came into the what? Business. So these two items must be clearly reflected in the books. If by any means you only record one aspect, maybe cash or fuel alone, your account will have an imbalance. So the rule of double entry states that for every debit entry, there must be a corresponding credit entry. It's as simple as that. That for every transaction, there must be a debit entry and there must be a credit entry for the books to what? Balance. Transaction. What is a transaction? Like I just mentioned, everything that happens on a business daily that involves the exchange of goods or money is known as what? A transaction. Example is, like I mentioned earlier, purchase purchase of fuel for the business, pay rent for the business, bought goods, sold goods, pay workers. All of them are known as what? Transaction. The daily activities that go on in a business environment on a daily basis involving the exchange of what? Money are known as what? Transactions. Debits and credits. Now, every account is divided into two based on the rule of double entry. Every account is divided into two, the left hand side and the right hand side. Now, the left hand side is known as the debit side. The right hand side is known as the credit side. So, whenever you hear debit, it refers to the left hand side of an account. If you hear credit, it refers to what? The right hand side of an account. I told you that accounts is an exciting subject. Just understand the principles and you're done for it. Okay, debtors. Who is a debtor? A debtor is anybody who is indebted to the business. Now, most people mistake this word for debitor. It's not debitor, it is debtor. That B is silent. A debtor is anybody who is indebted to the business. If anybody is owing a business for anything at all, that person is a debtor. And because it is a benefit the business will still receive, it is an asset, current asset in this case, we'll get there. But just know that whenever you hear that somebody is a debtor, it means the person is owing the business. The person is indebted to the business. All right. The opposite of a debtor is a creditor. A creditor is anybody to whom the business is owing. If you are running a business and you're owing somebody for anything, you are owing that person, and that person is a creditor. If you take a loan from a bank and have not paid, the bank is your creditor. If you buy goods on credit from somebody and haven't paid, that person is your what? Creditor. So anybody to whom a business is indebted is known as a creditor. All right, assets. Asset is anything that belongs to a business. Anything that belongs to a business is an asset. It could be land, it could be building, it could be motor vehicle, it could be machinery, it could be cash, it could be stock, it could be debtors, or what have you. But anything that belongs to a business is known as its assets. All right, asset is divided into two. We have fixed assets and current assets. Now, fixed asset refers to those things that belong to a business that are of a permanent nature and are intended to be used in that business over a long period of time. You know, when a business acquires fixed assets, they are not meant to be turned into cash in the immediate. They are put to use in that business for a long period of time. An example is when a business buys motor vehicle for distribution, that vehicle is meant to serve the business over a long period of time. So it is a fixed asset. When a business buys machinery for production, that machinery is meant to be put to use in that business for a long period of time. So it is what? Fixed asset. Any asset of the business that is meant to be put to use over a long period of time is of a permanent nature. and that is what? Fixed asset. Current asset, on the other hand, is the asset of a business that is easily turned to cash and cash to asset. It revolves in nature. It is not of a permanent nature. It easily changes its nature from one asset class to another. Take for instance, if you have a cash in the bank. Now we know that for a business, cash in the bank is not permanent because tomorrow you go to withdraw it to pay for what? Purchase of goods. At that time, the cash has changed its nature from cash to what? Stock. Tomorrow the stock is sold and you collect a cash. It means the stock has changed its nature from what? Stock to cash. Tomorrow you could sell the stock on credit, and then in the book you have a debtor, somebody who is owing you. So the stock has changed its nature from stock to what? Debtors. So any asset of the business which is not of a permanent nature but regularly changes its value from one form of asset to another is known as current asset. Examples are your stock, your cash at bank, your debtors, and so on and so forth. These are what? Current assets. Liability. What is a liability? Liability is anything a business is owing to external parties. Whenever a business is owing anything to an external party, that thing is a liability to the business. Now, if a business takes a loan from a bank, that loan is a liability because the business is owing the bank and will have to pay whenever it is agreed that they should pay. So whenever a business owes anything to external parties, that thing is a liability. Just like asset, a liability is also of two types. We have long-term liability and current liability. Whenever a liability is going to last for more than 1 year, it is known as a long-term liability. Any amount a business is owing to external parties that is more than 12 calendar months is known as what? A long-term liability. Which means if a business borrows money from the bank for more than 1 year, maybe a year and 6 months, 18 months, 24 months, 36 months, that is what? A long-term liability. But when a liability is meant to last for a short period of time within 12 calendar months, it is known as current liability. If a business buys goods on credit from their supplier and they are meant to pay in 2, 3, 4, 5, 6 months, that is what? A current liability. It means the duration of the debt is less than 12 calendar months. All right. Capital. What is capital? Capital is that initial amount that is put together to start a business. Before a business comes into existence, resources is required. And these resources is provided by the initial person who is floating that business. For a sole proprietorship, a business owned by one person, the capital is provided by what? The proprietor. For a partnership business, the capital is provided by the partners. For a limited liability business, the capital is provided by the shareholders. So that initial amount put together to start a business is known as a capital. All right. Depreciation. What is depreciation? Depreciation is said to be the fall in value of fixed assets due to some factors that play in between. Now, as we proceed, we'll talk about concepts and conventions in accounting. Now, one of the concepts, the cost concept says every fixed asset must be maintained in the books at their original cost of purchase. That's the cost concept. That whenever a business buys a fixed asset, at all times in the book, so long as that asset is still in existence, the Price stated must be the initial cost of a purchase, meaning if an asset is bought for 2 million naira, at all times that asset must appear as 2 million in the books. Now, this is to make for objectivity in valuation. Okay, now when it appears as 2 million in the books, you and I know that after 1 year, after 6 months, the value of that asset is no longer 2 million. Now, there has to be a way of writing down this value from time to time to reflect the current reality. Now, the method that is adopted to keep writing down the value of these fixed assets to reflect usage is known as what? Depreciation. So we say it is the fall in value of fixed assets due to what? Usage and other factors. But just know that what? This is a topic of its own and we'll look at it in future. But just know that depreciation has to do with what? The fall in value of fixed assets. All right. Fiscal year. Fiscal year. Please take note. Fiscal year is FISCAL, not PHY. No, not physical. Fiscal. Fiscal year. A fiscal year is a period of 12 months in which a business makes up its financial statements. A period of 12 months within which a business summarizes its financial activities to know what is the result of operation. It could be from January to December. It could be from December to November. I mean, every business chooses what their fiscal year is. But just know that it is a period of 12 months within which a business summarizes its operations to be able to determine if it's moving forward or not. Within this period, a business prepares what we call final accounts, we'll talk about it later, to know the extent of progress made or otherwise. All right, revenue. Revenue is the benefit a business receives for rendering services to external parties. When a business sells goods, when a business renders a service to external parties, the benefit it receives is known as what? Revenue or income. Are you getting it? All right. A business that is into services renders a service to a customer and the customer pays for that service. That payment is known as what? Revenue. Some others call it income. So revenue is the value a business receives for rendering service to external parties. The opposite of revenue is expenditure, or on the other hand, the opposite of income is expenses. So expenses is what? The payment a business makes to receive benefit from external parties. As an example, if a business rents a warehouse for its operations, it pays rent on monthly or yearly basis. That rent it pays is known as expenses. I hope you're getting it. All right. Then, if a business maybe has a building that it rents out to people and they pay the business rent, that rent the business receives is an income. But the one the business pays is what? An expenses. There are two sides of a coin. All right. Profit. What is profit? Profit is the difference between revenue and the expenses. It's as simple as that. Profit is the difference between revenue and expenses. At the end of the fiscal year, a business summarizes its business activities to determine if it is making profit or not. Now, what it does is to check every of its receipts and spendings, compare them to each other, and know what progress has been made or otherwise. So the difference between all the revenues and all the expenses, starting from production expenses if they're into production, sales expenses, and all of that put together, take it out of the total revenue received, you have profit or otherwise. The opposite of profit is what? A loss. Now, profit or loss is of two types. We have gross and we have net. Gross profit and net profit. Now, in the trading account, which is a topic of its own, one of the final accounts, we are able to determine if there is either a gross profit or a gross loss. Now, what is gross profit? Gross profit is not the true profit. It is just the difference between what a business buys and what it sells, what it produced and what it sells. A business who is into trading buys stock 10 million naira and sold it for what? 13 million naira. That is what? The difference between the 10 and 13 is 3 million, and that is gross profit. Now, here is where businesses have issues who don't know anything about accounting. As far as they are concerned, the 3 million is what? Profit, and it's available for what? Spending. But that's wrong. If you go that way, you're going to run that business aground. Now, that 3 million naira, which is the difference between your sales and how much you bought the goods, is known as gross profit. It is not the true profit because in the process of selling the goods, there were other costs that were incurred. You paid rent, you paid salaries, you paid for lighting, you paid for transportation, and all of that. Now, all these expenses have to be put together and deducted from that 3 million naira for you to be able to arrive at your real profit, which is the net profit. Now, the net profit is calculated in the profit and loss account, where you have your gross profit on one side and all your expenses are listed on the other side. At the end of the day, the difference between your gross profit and expenses is known as the net profit. Now, this is the real profit, which is available for what? Spending. If you are spending gross profit, you are hurting the business in so many ways. What you have to spend is your what? Net profit. But don't forget, don't spend it too much. Remember, the life of your business is important, the health of the business financially. What we're saying is that net profit is the real profit that is available for what? Spending. Okay. And on the flip side, your loss is also of two types, gross loss and net loss. Now, our scenario of buying goods for 10 million naira and selling for 13 million naira gave us a gross profit of 3 million naira. Now, imagine where you bought the goods for 10 million naira and due to some circumstances economically, you were able to sell them for only 9 million naira. It means you bought for 10 million and sold for 9 million. Invariably, there is a loss. There is a gross loss of 1 million naira. Now, that is not the real loss. If you're crying, oh, I lost 1 million naira, that is not your loss. Take note, your loss is far higher than 1 million naira because what you will now do, you have to bring back all the expenses incurred in the profit and loss account and add it to your loss. That will magnify your what? Loss. It means your gross profit is reduced by your expenses, but your gross loss is magnified by your expenses. If you're having a loss in your trading account, that loss will be magnified in your profit and loss account after adding expenses. But if you have a profit in your trading account, that profit will be reduced after subtracting your what? Expenses. So gross loss is the negative difference between your revenue and expenses. Okay, turnover. What is turnover? Turnover is net sales. Not all sales, no, net sales. What is net sales? Net sales is sales less returns. If you, in a particular month, sold goods worth 100 million naira, that is not turnover, that is sales. Now, that sales is gross because at the end of the day, There could be some customers who were not satisfied with what they bought from you and they returned it to you. Now, for you to have your net sales, you need to deduct all the goods that were returned to you from total sales to get your what? Turnover. So, assuming they return goods to you worth 5 million naira, your turnover will have to be what? 100 million less 5 million, meaning your turnover will be what? 95 million naira. So turnover is net sales. That is what? Gross sales less returns inwards. Okay, accruals. Accruals. What is an accrual? Oftentimes, a business receives a benefit that has not been paid for until the end of an accounting year, until the end of a fiscal year. Now, whenever a business receives a benefit and did not pay for it before the end of the accounting year, that expenses is said to be what? Accrued. So accrual has to do with benefit received by a business which has not been paid for. As an example, a business rents an apartment which is supposed to pay for within the year, and then the year ended. It either paid in part or has not paid at all. In the following year, that unpaid part of the rent is called accrued rent. It means that benefit has been used up, but it has not been paid for. If a business is supposed to pay salaries to the workers this month and did not pay that salary, by next month, that salary has been what? Accrued. And it's a liability to that business because the business is owing the workers. So whenever a business receives benefits which it has not paid for, that is said to be what? Accrued expenses. On the other hand, the opposite of accrual is what? Prepayment. Prepayment occurs when a business pays for a benefit in advance and has not received that benefit until the end of the accounting period. Take for instance, a business is supposed to pay rent 1 million naira per year, and then in the year under review, it pays for 2 years 2 million naira. Now, at the end of the year, it has only used up 1 year, that's a million naira. The landlord is still owing him 1 million naira. That 1 million naira owed to him by the landlord is known as what? Prepayment. It means it paid that rent in advance, which means in the coming year, it's not going to pay any other rent. So whenever a business paid for a benefit it intends to receive in advance, it is known as what? Prepayment. And prepayment is an asset because somebody is owing the business for that benefit that has been paid for. All right, remember, if you have not subscribed, hit the subscribe button. Don't just miss out on these beautiful benefits we are giving out. Hit the subscribe button, turn on your notifications, like this video, give our videos likes, and then use the comment section for anything you want to tell us or say to us, question, commendation, whatever it is. We don't mind. We want to hear it all. And then invite your friends to subscribe. Bring them on. Let's bring out the accountant in them. All right, let's proceed. Cost of production. As the name implies, for a business who is into the production of goods, cost of production refers to the total amount spent in producing a given output. Whenever a business produces goods for resale, let's say at the end of the month, a business produced 10 tons of tissue. Okay, 10 tons of tissue rolls, worth 100 million naira. Now, the cost of producing that 10 tons of tissue is known as what? The cost of production. Now, for you to be able to fix your selling price as a producer, you must know what your cost of production is. And this is what is done in the manufacturing account. So the essence of preparing a manufacturing account is to determine what the cost of production is for a given output. Because it is only when you know what it costs you to produce a given output that you'll be able to know how much to sell that product for. So, cost of production refers to the amount it costs to produce a given output. Cost of goods sold. Cost of goods sold. What is cost of goods sold? Cost of goods sold refers to everything it costs you to sell a particular quantity of output in a given period. Like we said, if you are considering your cost of goods sold, you need to look at your sales to bring it to net sales. That is your sales less returns. You have your turnover. Now, you now consider every other thing that transpired that needs to be deducted from that turnover to arrive at how much it costs you to sell a given output. Now, this is done in the trading account. In the trading account, for you to calculate your cost of goods sold, you have your opening stock of finished goods, you add back your purchases, you less returns inwards, you add carriage inwards, that is if they are all available, then you less your closing stock. Once you less your closing stock, what you have is cost of goods sold. What you have is how much it costs you to sell a particular quantity of product. That turnover you're seeing on the other side of the account, what it costs you to sell it is what we arrive at after deducting a closing stock, and that is cost of goods sold. All right. And when you compare your cost of goods sold to your turnover, you arrive at the gross profit. I hope it's making sense. I hope you're getting excited. I am. I'm being fired up. I'm being charged up. Okay. Bad debts. Bad debts. Bad debts. A debt that is bad. A debt that is irrecoverable. What is a debt? A debt is that amount that a customer is owing a business. Take for instance, a business sells products to a customer on wholesale worth 2 million naira. Now, in the book, that customer appears as a debtor, which means he is owing the business. Now, he is meant to pay for those goods after a certain period agreed between the two of them. Now, take for instance, that period expired and the customer was unable to pay for certain reasons. Probably the business environment was becoming too harsh for the customer. And so the customer was unable to pay all or a part of what he is owing to that business. And after some time, that business closes down completely. Like the business shuts down and discontinued operation. So long as that business has failed and there is no chance of recovering that money owed by the customer, that debt is considered a bad debt, which means it is what? Irrecoverable, and it is a loss on the business. But you can't avoid it because the business environment is filled with what? Uncertainties. You never can tell what will happen. It could be policies, it could be anything that could affect the business and cause it to close its doors. So bad debt is that debt owed by a customer who has discontinued operation and has no way of paying. It is known as what? Bad debt. It is written off. It's gone. Otilo. All right. Now, we have bad debts and we have provision for bad debts. This is lighter. Bad debt is certain. Provision for bad debt is notional. It means it is a matter of decision by the business. Take, for instance, that man who is owing the business 2 million naira, maybe as time goes on, the business begins to see that, this man is not doing well again in his business. What is going on? He was supposed to pay for these goods in March. And then March came, Instead of paying 2 million, he paid 200,000. It's unlike him. Okay, we kept watching him. Now he usually buys goods from us. Maybe every 3 months he comes and buys and sells and buys again. But at this time, after 3 months, he didn't buy anything. 6 months, he didn't buy anything. It appears his fortune is dwindling. The business is going down. He's not making any progress. And we look at it. This man's business is not doing as well as it used to. And if we keep carrying this debt of 2 million naira, it will run us into problems. So the business decides, okay, now this debt is not bad yet because the man is still running his business, even though it's not as good as it used to be. Let's write off a part or all of these debts. Are you getting it? He's still in business, but the business is not doing well again. Instead of carrying this debt in the business and giving us a false value, knowing that the debt may never be recovered, what do? We decide to write off all of it or a part of it. We make provision for any exigency that may occur. That, okay, oh, the man at the end of the day may not be able to pay this money again, so let's write it off. So we are making a provision for the uncertain event that may occur in future. That is what? Provision for bad debt. Now, take note. Bad debt is certain. It is irrecoverable. Provision for bad debt is a decision made by a business to safeguard what? The business assets. Instead of carrying a debt of 2 million naira in the book, which may never be recovered, let's write it off entirely. So we make a provision to write this debt off. If at any point in future the man's business takes a new leaf and he pays for that money, we will bring that debt back to life and recover it as what? Bad debt recovered. But in the meantime, make a provision to do what? Write it off. That's provision. So the bad debt has not occurred, but we decided to do what? Write it off. That is making a provision for something that may happen in future. Why do we do this in accounts? When we start talking about conventions and concepts, one of the concepts says accounting doesn't look too much on the bright side. We try to make provision for whatever evil may come. But if it is benefit that may come, we look at it skeptically. We are not too sure about this. Let's watch it and see how it unfolds. But once we see a glimpse of a loss coming, we cover it. The essence is that we don't want to overshoot profit so much that when we start looking for it, it is not there. So what we do in accounting is to look on the bleak side somehow so that if eventually it becomes a bleak, we have it covered. If it turns around and becomes profitable, then we celebrate it. So that is that. So provision for bad debt as opposed to bad debt is notional. We decide this thing is still there, but it may not be there eventually. So let's provide to write it off. If it comes back, good. If it doesn't come back, we know we are covered already. All right, discount. What is discount? Discount is the benefit given to customers to encourage them to do more business with the company. It is a reduction in the value of either the goods bought or the amount to be paid by a customer in order to encourage a regular purchase. A business often decides, okay, these goods cost us, we are selling it for 10 naira or for 10,000 naira. Now, in order to encourage customers to buy more or to pay promptly, let's reduce the price by 5%. So that reduction in the price of a product to encourage a higher purchase is known as a discount. It is of two types. We have trade discount, we have cash discount. Now, when a business say, okay, want to sell more of this product, seeing that we can still cover up our cost and make a little profit, we are selling this product for 10,000. Now, if you are able to buy up to 100 pieces, we'll give it to you at 9,800. given a 200 off. That 200 is known as what? Quantity discount or trade discount. Now, a quantity discount is that discount given to encourage more purchase, to encourage greater patronage. You give quantity discount of 20 naira. People say, it means if I buy these goods, I'm going to make extra 20 naira. Please give me 1,000. Instead of buying 200 or buy 500, I buy 1,000 because I'm going to make more profit. So that discount that is given to encourage greater quantity purchase is known as a trade discount or quantity discount. Then we have cash discount. Cash discount is that discount given by a business to encourage prompt payment by its customers. Now, cash discount is given by a business to its customer to say, okay, if you pay within 2 months, you get a discount of 5%. If you pay within 1 year, you get a discount of 0%. Now, that amount that is given off to encourage customers to pay on time is known as what? Cash discount. Now, cash discount is of two types, discount allowed and discount received. Now, discount allowed is that given by a business to its customers to encourage them to pay promptly, to pay on time. Discount received is the one a business receives from its suppliers to encourage it to pay them on time. Now, in the books, we don't have anywhere where we treat trade discount or quantity discount. No, it goes off with the sales and the invoice. But cash discount is what is carried on in the books as either discount allowed or discount received, depending on who is given and who is receiving. Okay, final accounts. What is final account? At the end of every fiscal year, a business summarizes its financial activities to know if it is making progress or not. Now, the way to find out if progress has been made or not is to prepare what we call final accounts. That is an account that summarizes the entire activity of that fiscal year to know if there is a profit or not. Now, final account has various branches. At the end of the year, a business prepares, if it is into production, it prepares the manufacturing account to determine what is the cost of production. It prepares the trading account to determine what is the gross profit. It prepares the profit and loss account to determine what is the net profit. It prepares the cash flow statement to determine the extent of availability of fund for its future operations. Then it prepares the balance sheet to be able to determine the true value of that business at any given time. These accounts put together are known as the word final accounts. The trading account, the profit and loss account, manufacturing account, the cash flow statement, and the balance sheet. These accounts are prepared at the end of a fiscal year to determine the extent of progress made or otherwise. All right, subsidiary books. What are subsidiary books? Subsidiary books are otherwise known as books of original entry or books of prime entry or books of first entry. Now, we'll look at it in detail as we proceed. These are the books where transactions are first recorded in the business before continuing their journey in the business. Now, there are a sets of books that a business must keep on daily basis to capture its daily operations. These books are known as what? Subsidiary books. It includes the cash book, it includes the sales journal, purchases journal, returns inwards book, returns outwards, the general journal, and so on and so forth. These books are called books of original entry, books of first entry, subsidiary books, because every transaction must first pass through them before proceeding to the ledger, the trial balance, and then final account. All right, carriage. Carriage is the amount paid for the movement of goods from one place to another. If a business sells goods to customers, the cost of moving that goods from the business to the customer's place is known as a carriage. If a business buys goods from its suppliers, the cost of moving those goods from the supplier's place to the business is known as a carriage. Now, carriage is of two types. There is carriage inwards and carriage outwards. So, carriage inwards is a trading account item. It is added back to the cost of a goods sold. And then carriage outwards is written off in the profit and loss account as an expenses. All right, returns. Returns has to do with when goods that we originally bought for resale are sent back to the place where they were bought because they were rejected for various reasons. Now, if you buy goods for resale, it's expected that the goods should be sound when they get to your business place so that you'll be able to sell them. Now, oftentimes, due to movement of the goods from one place to another, some of the goods, when they arrive, may not be sound. Some may not be in good sellable condition. What do? You don't take responsibility because it's not sound. You have to return it to the person who sold it to you. Now, that action is known as a returns. That is taking goods bought for resale back to the seller because something is not right somewhere. Now, it's of two types, returns inwards and returns outwards. When a business sells goods to its customers and the customers, for obvious reasons, returns the goods back to the business, that is returns inwards. It means the goods are returned back into the business. When a business buys goods from its suppliers and finds a fault in the goods and has to send it back to the supplier, that is returns outwards. Are we getting it? All right, returns inwards is deducted from what? Total sales. While returns outwards is deducted from total purchases. It means when we buy goods for resale and we find a fault in those goods, we send it back to the supplier. That is returns outwards. And it is deducted from total purchases. Returns inwards, on the other hand, when we sell goods to customers and they have a reason to return it to us, that is returns inwards. It is deducted from what? Total sales. It means if your sales is 10 million and customers return goods to you worth 1 million, it means your net sales or turnover is 9 million. If your purchases is 20 million and you return goods worth 2 million to suppliers, then your purchases is equals to what? 20 million minus 2 million, that is what? 18 million. All right, contra entry. What is contra entry? Now, there are items in the cash book that are recorded twice in the same cash book. Normally, every transaction is recorded once in the subsidiary book, and then the second aspect, based on the principle of double entry, is completed in the ledger. If you have a cash book, you bought goods and paid cash. What do? You credit your what? Cash book to indicate that money has gone out of that business. That is one recording. Now, the second aspect of that transaction recording is completed in the ledger. But there are transactions that are recorded twice in the same cash book. So whenever a transaction is recorded twice in the cash book, both on the debit side and the credit side, that transaction is known as a contra entry. Now, the implication is that contra entry does not go to the ledger anymore because everything about it has been completed in the cash book. An example is this: when cash is moved from the business to the bank. Now, in the cash book, the cash appears on the debit side, and then you move it to the bank on the credit side, which means the money left the cash till and moved to the what? Bank till. Two things has happened. The cash account has both been debited and credited. It's been credited by money moving out of the business cash account, and it's been debited by money moving into the business's bank account. We're talking about a double column cash book, or triple column cash book, where you have cash, bank at on both sides. That is, the amount column is divided into cash and bank. So when you take money that is existing in the cash column and pays into the bank, it means the money has left the cash till, and the credit side of the cash account is recorded. Now, the money goes into the bank, meaning the debit side of the bank column is what used. What has happened? Both sides of the account has received their entries. It means for cash paid into the bank, credit side of the cash account is recorded, and debit side of the bank account is what? Recorded, meaning money left the cash column and came into the bank column. That is known as contra entry. Or when money is withdrawn from bank to cash, that is contra entry. This type of entry is not posted to the ledger. You often see it denoted by letter C, showing it is what? Contra on both sides. So it doesn't go to the ledger at all. Closing stock. At the end of the fiscal year, a business determines what is the value of goods for sale. Now, whatever value of goods available for sale at the end of an accounting year, at the end of a fiscal year, at the end of an accounting period, is known as its closing stock. You must have heard about stock take. At the end of every accounting period, a business conducts stock taking to determine if the actual stock in the book tallies with what is physical in the business. Now, in most businesses, stock taking could happen monthly or quarterly or annually. So whenever that is done, whatever is the value gotten from the physical counting of your stock is known as a closing stock. All right, drawings. Whenever a business owner takes money out of the business for his personal use, that is known as what? Drawings. It's as simple as that. A business owner takes money from the business for his personal use, that is drawings. Remember, we tried to emphasize earlier that a business is separate from the owner. And so when a businessman invests money in that business, it's like he's given a loan to the business, because they are two different entities. So whenever he takes money out of the business, it's like he's borrowing money from the business or drawing from his capital. What happens is that if we are fully double entry of the money invested in the business, when a businessman say invests 10 million naira in the business, what happens? We have the asset of cash debited with 10 million naira, and we have the liability of capital credited with 10 million naira. Now, that capital account is kept on behalf of that owner, because it means the business is owing him 10 million naira. Whenever he makes a drawing, let's say after 1 year he needs a new car, and the business is profitable, he takes 2 million naira from that business to buy a new car. That 2 million naira is debited to the capital account and credited in the drawings account. Now, what this implies is that when you balance the capital account, it means the capital of that business has been reduced by 2 million naira, meaning it is only standing at 8 million naira. So drawings is whenever a businessman takes money out of the business for his personal use, and that singular action reduces the capital of that business. except of course when there is profit to cover for that. Okay, sole proprietorship is a business owned and managed by one person. Don't get it twisted. It is not limited to that small business by the roadside owned by one man. No. A sole proprietorship kind of business may be as small as that one by the roadside or as large as a bigger company with 100 or more employees. But the whole idea is that what? The business is owned by one person who has employees running the business for him. Now, partnership business is almost like a sole proprietorship in terms of the law, except that more than one person are responsible for the business. Now, in a sole proprietorship kind of business, the business owner will suffer losses if the business makes a loss because there's no more separation between the business and its asset, between the business and the owner. In a partnership too, the same thing happens. If the business sustains a loss that needs to be paid, the partners are held liable. Now, limited liability company is that kind of business whose liability of the members are limited only to the amount they contributed to the business. For a start, what do we mean? In a limited liability company, the members are only liable for the business's debts to the extent to which they have paid or have agreed to pay for the business to take off. It means if the business needs 100 million and there are 10 shareholders who both agree to pay 10 million naira each, if anything happens to that business, all they can lose is the 10 million naira they have paid or agreed to pay. They can't lose anything more than that. But in a partnership, if the partners agree to pay 10 million naira and they all paid it, if anything happens to the business and the business cannot take care of itself, the partners will have to take responsibility by looking for money to sort the business out. The same thing happens with a sole proprietorship kind of business. But in a limited liability company, the partners can only lose what they have invested or agree to invest in that business. Interesting, right? I told you. Well, limited liability is of two types. You have the private and the public. These are things you study in future, but the difference is only in terms of numbers. The number of persons needed to form such business. But in both the private and public, the liability of members is limited to what they have paid or agreed to pay to start the business. And again, for a private limited liability company, its shares cannot be sold on the floor of the stock exchange. But for public limited liability company, its shares can be sold on the floor of the stock exchange. All right, capital expenditure. What is capital expenditure? Capital expenditure is that expenditure made by a business to acquire assets that are of a permanent nature in the business. Whenever a business pays to buy assets that are meant to be used in that business for a fairly long time, it is known as what? Capital expenditure. Now, capital expenditure is not limited to the value paid for that goods, for that asset. It includes every other cost incurred to bring the asset to usable state. Take note of this very well. If a business is buying an asset, the value of that asset in terms of capital expenditure is not limited to the amount paid for that asset. Rather, it involves every other amount paid to bring that asset to a usable condition. At the end of the day, the value of capital expenditure on that asset involves the amount paid for the equipment overseas, the legal fees paid to sort out the payment, the cost of shipping from overseas to Nigerian ports, the cost of transporting those goods from the port to the business environment, the cost of unloading it, the cost of installation, everything put together is known as a capital expenditure. So it refers to all the expenses incurred to bring in a new product, a new equipment, a new as fixed asset to a usable state. That's a capital expenditure. Then we have revenue expenditure. What is revenue expenditure? Revenue expenditure is any expenditure made to foster the day-to-day running of the business. Now, the money a business spends on daily basis to keep it running is known as what? Revenue expenditure. Example is rent or rates or salary or all of that. Those are expenses incurred to enhance the revenue generation of a business entity. Now, when a business buys a motor vehicle, it is what? Capital expenditure. When a business repairs the motor vehicle, it is what? Revenue expenditure. When a business pays for fuel for the motor vehicle, it is revenue expenditure. So those expenses incurred to foster the smooth running of a business on daily basis is known as what? Revenue expenditure. And then the expenses incurred to buy assets that are of a permanent nature that will be used in the business over a long period of time are known as a capital expenditure. Whoa, interesting. This has been a whole lot. You know, I told you accounting is fun and exciting. If you are able to understand these terms listed here, then you are on your way to being an accountant already. Try to go through this video one or two times to ensure you understand every word that has been defined, every time that has been defined here. Once you understand them, because you keep hearing them as you proceed from year one to year two, year three, final year, when you start working, these are the times you keep hearing on a regular basis. So getting them to heart will help you do well in accounting. Woo! Exciting and interesting. I mean, this is a whole lot. I am really excited. I am fired up. I hope you had fun. I hope you enjoyed this video. Like I always told you, if you enjoyed it, give it a thumbs up, give it a like. It ain't gonna cost you nothing. Show us love now. Tell us you love what you are doing. Give this video a like and then share it to your friends. Share it to them. Let me tell you, no lecturer in school will have the time to explain these times to you. They don't have that time. All they do is to tell you one or two things and then give you assignments or whatever it is, and they go their way. Even in secondary school, you may not be able to learn all of these things because most persons start doing accounting in SS1, and you're very limited in terms of what you're going to learn within that 2 or 3 years. So the job we are doing here is basic to your success in accounting. So what do? Give this video a like. Subscribe if you have not. Share this video to your friends so that they can come on board and subscribe and enjoy this benefit you're enjoying. Let's make this video, this channel go viral. We are here to make it work, to bring out the accountant in you. Turn on your notification if you have not, so that whenever a new video is posted, you will be aware of it. Remember, the story today was on terminologies, definition of terms. In the next video, we will go into something more exciting. Keep yourself glued on this channel. Like I said, make it your personal study space. Cheers.